Hey everyone, welcome back to the Daily Gold podcast. I'm here with Dave Skarica of AddictedToProfits.net. Dave, I think it's been at least a few weeks since we've talked and done an interview here, and obviously a lot of interesting action in the markets, especially the precious metals market, and gold breaking down. The gold stocks. You can't say the gold stocks have broken down, though. I mean, it looked like after yesterday they were going to print new lows out of this year-long consolidation, but a nice rebound today. What are you seeing here in the gold complex, specifically with the equities?
I actually really like what we're seeing. Two notes is that on a closing basis, we went below the most recent low on gold, meaning the fall low. And we didn't break the intraday low. But the stocks actually didn't go below either intraday or closing low of the fall. And we held the 482 low on the HUI and never got below 494. The HUI to gold index ratio got down to 31%, which is a really cheap level and a good level to buy gold and gold stocks. And what I really liked about what I saw on this most recent decline, more than the price action, was actually just the sentiment. If, say, you ignored the price action and you just were reading, what people were saying, that Dennis Gartman give it he must be smarter than the rest of us because he knows this is the end of the secular bull market. So him gave him a sell signal, and we just saw all kinds of negative things that because of the euro crisis and European banks problems, gold would continue to sell off, and things like Holbert Financial Digest and some gold timers indicators like Ridex ratio and another one that Peter Brimlow follows, the CBS Market Watch. All these sentiment ratios were showing actually the lowest levels for the most part since the fall of 2008, which of course was a major low for gold. And interestingly enough, it seems that every 3 years during this bull market, being mid to late 2002, 2005, 2008, now 2011, there seems to be a pretty significant low in the gold market. So this all coincides with this excellent kind of negative sentiment that we've seen, that most people have been cleared out of the market. And I think there were a lot of reasons from this, but I think one of the reasons that no one was really talking about was I think this MF Global bankruptcy had a bigger impact than people wanted to make it. People just looked at it, oh, it's another Madoff, it's another fraud. But unlike Madoff, which was just an out-and-out Ponzi scheme, and he really held no securities, really, because he just, money would come in and then it would go out. With MF Global, they tried to hide some of their losses by moving accounts over. And long story short, they're just liquidating everyone's account. And by most of the articles and things I'm reading, they're going to pay out investors about 72% of their money back, which means that MF Global owns, gold coins for some of their customers. They own gold futures. They own commodity futures. So they just got to go in the market, liquidate all that. And, when you liquidate, you don't exactly care about the price you get. It forces the market lower, then pay out their customers roughly 3/4 of their money. And that, I think, had a significant downturn on gold, because when the liquidation was supposedly going on, coincided with this big drop in the price of gold. And remember, gold and commodities markets are much smaller and more liquid than equities markets. So, of course, something like MF Global being forced to sell for a few weeks was going to push them lower.
Yeah, I think that's a great point. And the other factor, and one reason why I think that's a great point, Dave, is because precious metals, the complex has been relatively weak compared to, and commodities in general, compared to equities. I mean, you look at the S&P and some emerging markets, I mean, in the last couple of weeks, they've held up much better than commodities. So that would kind of lend some credence to what you're talking about there.
Yeah, I would agree with. And see, another thing with emerging markets is you look at actually, I saw an interesting stat where European banks own about $3.5 trillion worth of emerging market debt, and American banks only own about a tenth of that, about $340 billion. So what's happened too is we're seeing people pull money over out of European banks because they also own a lot of European debt. So what happens if you have to raise capital of a European bank? You're going to sell your Indian or Brazilian or Chinese bonds and turn around, to raise capital, to raise the capital requirements at your bank if you're seeing outflows of deposits. So that's also, along with everything else, hit emerging markets as well. Like, I think that is a major reason we've seen, for example, the big decline in the rupee, because these European banks have essentially been forced to sell things. So what we're seeing is when you get these liquidations, it's not really based on fundamentals. Kind of like 2008, when despite the fact that most emerging market economies were still holding up pretty well, their markets fell the most because people were pulling money out just because they had to meet margin calls or whatever. So I think we're seeing a lot of a mini version of that. I obviously don't think we're going to see an all-out move lower 2008. Like if you look at the American market, it's actually holding up quite well. Like the S&P just had a huge update today, up over 3% as we're speaking, and actually is at the higher end of its recent trading range. So I think a lot of this was short-term phenomenon due, to European banks having to raise capital. It's MF Global thing. And, when selling usually begets more selling. You get selling, you get guys with more margin calls, and they have to sell more. And then all of a sudden, that most hedge funds had a bad year, and that you're going to get redemptions come January when people look at your year-end performance. So you just got to sell everything, including your gold position.
Yeah, and I want to go back to the consolidation in the gold stocks. Looking at GDX and the HUI. A couple points here. You mentioned the sentiment. I mean, this is the type of sentiment that you would see at the end of a consolidation, because this market has been in consolidation for a long time, and obviously, people they're getting frustrated. Gold's gone up this year, and the gold stocks have basically done nothing for 12 or 15 months, and that's kind of what you tend to see, I think, at the end of a consolidation. The other thing is, I think we have to look at the composition of these indices, the large cap gold stock indices, and looking at the HUI and the GDX. Three stocks make up, I think, about 40% of the index. Newmont, Barrick, and Goldcorp, and most of that I think is Newmont and Barrick. And if you look at Newmont and Barrick, those, if you look at the charts of those stocks, I mean they're relatively healthy compared to the rest of the sector. So you look at those three names, they don't look like they're going to have a big breakdown. Sure, they could go down a little bit more, but for the Huey or the GDX to really have a more than maybe a 5 or 7% decline, I think you would need to see those three leading stocks really kind of break down, and just looking at those charts, I don't think that's going to happen. So
and then you look at it like stocks like Agnico that have broken down, it's the other side of the coin. Are they really going to drop that much further? Agnico has fallen now 60% since its high in December of 2010. Is it really going to go down another 15 or 20 or 30% from here? Probably a lot of the bad news has been baked into the cake with a stock like that. So I agree with you, where you've got the real leaders, without technical damage, and the stocks that do have technical damage probably have very limited downside from their current levels. So, where are you really going to go on these gold stocks? And from a valuation point of view, from everything from, price to sales to price to earnings to, the price divided by the price of gold, these stocks are all trading at, some of them 2008 levels at the bottom there, some of them back to like 02 levels when gold was $250, $300 an ounce. So we just see very, very cheap sector. And what's really, I find amazing about this, and I think this is the big opportunity, is that you're getting to buy a sector that's in a secular bull market, meaning we're in the 11th year of this bull market, about to enter the 12th. But you're buying it at the bear market valuations. Like, for example, from 1982 to 2000 in equities, you never got to buy stocks in the late 80s and mid 90s at 8 times earning yielding 6%, 7% like they were in 1982. But now you're getting to buy these gold equities at those 2001 valuations in the middle of a bull market. And that to me is like a fantastic opportunity. And it stinks that we've sitting here on many people are sitting here on losses or gains have been muted because we're waiting for this to happen. And, obviously the Euro crisis has really kind of dragged this out the last 6 months, but it also gives you a wonderful opportunity if you're not fully invested in the sector. And then, we're also in the seasonal time frame where usually you see a small correction maybe sometime in December, early to mid-December, which then follows with the year-end rally, followed by the first quarter rally in gold stocks. And if you look at the last 2 years, gold and gold stocks have corrected each case in January. And I think what's happened this year is we're just seeing that a month early. Like actually, last 2 years, gold stocks peaked in December, saw a correction into January, then the resumption of the rally. And I think what's happened this time around is that correction has come about a month early, and we'll probably see this rally continue, in January and February. And this is probably the correction we saw in January just happening in December.
Right. Yeah. And a couple points here. First, going back to, we were talking about the kind of the breakdown of how the gold stock indices were looking. If you look at the bullish percent index on the gold miners, it's basically, I think the percentage tells you what percentage of the stocks are on a buy signal on a point and figure chart, and it's down to 13% now. And that basically is we're talking about a daily closing level. The only time it went lower than that was basically in November and December of 2008. So we're basically, that kind of I think confirms what you're talking about how a lot of the stocks in the index are very, very oversold. So you have, the big ones at the top that make up most of the index are strong, and then the rest of the stocks are very significantly oversold. So that kind of bodes well for a rally. And then just to piggyback on top of the point you're making about how we're I don't want to say we're deep into a bull market, but going into the 12th year, Dave, I mean, how many years is this thing going to last? I don't think it's going to last like 23 years. I mean, who knows? But I think if based on history and other things I like to look at, I mean, I'm thinking this is going to be a 17 or 18 year bull market. We're getting ready to begin the 12th year. You're getting to buy at a discounted valuation deep in a bull market. I mean, this isn't early in a bull market. I think we're a little bit past the halfway point. It kind of, I've said it before, but it kind of feels kind of similar to in the early 90s, with the NASDAQ. I think in 1994, where people were kind of worried we were going to go into another recession, and then they pumped a lot more money in, and that kind of, that was really the beginning of a tech bubble. So, I mean, you're more of a historian on the markets than I am, but it just feels a little bit similar to that. Just because, I'll say it again, we're about to be 12 years into this thing, and we know this is a bull market, and it's the bubble and the mania lie ahead of us. So if you don't want to buy gold stocks now, when are you going to buy them?
Yeah, I agree with you. I've always looked at this at a 15 to 20 year bull market in my cycles, and if you, depending on either gold or the gold stocks, you're either fourth quarter 2000 or April 2001. Is when the bull market started. So yeah, I'm looking at the 2015 to 2020 period as a potential top. So yeah, I would agree with that. Next year being 2012, I would say another 5 to 6 years is pretty fair left in this bull market. And now that gold is being accepted by some of the mainstream public, they just have to take that next step to getting into the stocks. I think, yeah, we're nearing that, what you talked about, that 94, 95 to 99, 2000 period, where stocks went up, 25% annually. And we could definitely see that in gold and gold stocks the next 5 to 6 years after this kind of correction. Because really, I think we're going to see the QE and money printing on steroids coming up. The ECB is trying to be a good central bank in terms of not printing money just to monetize all the debt. But I think they're just getting their hands going to be forced, and they're going to have to do that just because the fiscal deficits are so large, and there's no other way to really sustain them while you're doing a period of austerity to get them lower. So I think you're going to have them printing money. The U.S. is going to continue to print money. The Chinese are loosening blank lending requirements. I see the Indians doing the same soon as their economy is slowing at the moment. So I think you're going to have, like I said, money printing on steroids, where maybe in 2008, you had China loosening and U.S. loosening, and the Europeans still kind of had, their hand close up at their, against their vest. But now I think it's like everyone's going to be printing money like crazy. So that's really going to portend well. And I think you're going to start seeing announcements of that as soon as mid-January, when the Fed meets next, and the European Central Bank is going to do the same. I think right now people have kind of just coasted into the holidays, and we're going to really see the ramping up of the money printing. And just to change the note, my final point here, One thing I'd really be looking at are the junior stocks. This is kind of like a miniature version of 2008 we've seen in the junior stocks. That despite the fact that we've seen hot gold have a good year, most of the junior indices are down like 30%. We've seen like the CDNX index drop from like over 2,200 to about 1,400. It does seem to be building a nice base here in the 14 to 1,500 range. It actually I think it went just over 1,300 at its low. And a lot of that has to do with like the lack of liquidity or liquidity problems coming out of Europe. But if they do more money printing, we get higher precious metals markets and the liquidity kind of comes back. These junior stocks could really roar, and they're really susceptible to tax loss selling because somebody may be down 50, 60, 70% in the junior stocks. They get that out of my face and then just dump it at any price. And because they're illiquid, that pushes it down even lower. And if you look what happened in late 08, you saw a huge move upwards in January of 09 as the junior mining stocks, kind of came out of that low. That was, obviously because of the financial crisis and then tax loss selling, drove them even lower in the fourth quarter of 08. So that's something I would really look at here. If you have a junior miner you like that's been, knocked down by a lot of tax loss selling, I'd really look at that here, in the last, say, I guess there's probably like 6 or 7 trading days left in the year. I would definitely look at that.
Yeah, I completely agree. And on that note, Dave, we got to end it here. But Dave Skarica of AddictedToProfits.net, thanks so much for joining us today.
Thanks for having me.